Welcome, performance managers. Value drivers and non-monetary KPIs are the topic of this teaching video. KPIs are at the heart of performance measurement and lay the foundation for performance management. But how do they add value for companies? And how can we generate and devise new KPIs? These are key questions for this video. Stay tuned. What are the learning objectives for this module? First, understand the concept of value drivers. Second, identify various non-monetary KPIs for different businesses and different business segments. Third, be able to apply non-monetary KPIs to startups. And finally, fourth, devise KPIs for whatever situation necessary. KPIs are at the heart of performance management. Let's get it beating. You have probably already heard about the DuPont model, the mother of all value driver trees. It tries to arrange classical information from the accounting sphere and put them together into a tree of value generation with the ending value of return on investment. So we have two different streams. The first one is on assets and the other one on profit. So let's follow the first one. We take all the current assets and add the fixed assets. And we divide total sales of a year by the assets, which gives us the asset turnover. The asset turnover as such shows how many times have we used the assets per year as percentage of total sales. We then look at the profit line. The profit line works like that we take the sales, we deduct the operating expenses and add eventually non-operating income and end up with the earning before interest and tax. We divide earnings or the EBIT by sales and end up with a profit margin. So we have asset turnover and the profit margin. And when we multiply both, we end up with return on investment. Wonderful. So we already see there are two different ways to generate value. First, by turning over the assets, especially the current assets, as fast as we can. That means selling as much as we can. Or by selling goods or services that are of high profit margins. You might say this is nothing spectacular, but it's still an interesting idea to systematically visualize how value is generated. The underlying question of value-driven performance management is, how do we generate economic value? And based on the idea of DuPont, we have a sales margin and we have asset productivity. Yes, so far so easy. The question is, what drives our business? And if we look at the sales margin in more detail, yes, we can set sales targets in terms of values. We can talk about the cost of goods sold, which is the costing situation of the products and services we sell. And we have other aspects like R&D costs, SG&A are other administrative costs. As far as asset productivity is concerned, and you probably already know, inventory turnover, capacity utilization rates and cash turnover rates. But the real question is what drives our business. Because if we don't sell products, inventory turnover doesn't make any sense to us. If we don't have R&D, then this number is meaningless. So there are a lot of interesting KPIs that try to answer that question. So we have the Net Promoter Score, customer churn rate, new product development time, downtime, order size, days of sales outstanding, all of that. The question is, how do we reverse from these KPIs and from the activities that we do in business to create economic value? So this is maybe the main question of business administration. How can we create value? And what are the right drivers for it? So is order size important? Is the number of calls we do with customers important? What is important to satisfy our customers? What is important to generate value for the company? So, and this is the key topic of performance management, and the value drivers try to help us to build value creation processes. We're talking about KPIs as if everyone knew what KPIs mean. KPI stands for Key Performance Indicators. So these are not just indicators for any performance, but the key performance indicators. If we have a list of 100 performance indicators, that is probably meaningless for us unless we have an artificial intelligence to run the system. KPIs should be a selection of most important ones. But it's not enough just to come up with KPIs. At the end of the day, we should generate objectives and smart objectives. And just in case that you haven't learned so far what SMART means, this is just a brief reminder. So S stands for specific. Specific means with regard to special situation. What is the performance you're looking for? What is the situation, the business, the life situation you're in? So your KPI has to be very, very specific for your individual problem. Second, it needs to be measurable. It has to be objective and ideally auditable. This is not easy. Many things, especially like quality or satisfaction, are quite complicated to measure, and it's difficult to get objective measures. So it is key that we get a measure, and maybe a proxy measure is better than none. A stands for attractive. What does it mean? It has the objective that we generate should be ambitious, and R still realistic, not too ambitious. And T should be time bound with a clear deadline. So this is just a brief repetition. I know that most of you already know how SMART objectives work and what the link to KPIs is. So now let's have a look for different KPIs, popular KPIs that are well known among the business community. Let's start with KPIs for managing customer side performance. Number one is the conversion rate. The conversion rate is about answers the question, how effective are our measures, our campaigns. For example, the percentage of interactions that result in a sale. So we have the number of interactions with completed transactions. We divide it over the total sales interactions, and then we have a conversion rate. So what's the percentage of people who come to our website and start the process of the buying journey and actually end up buying. Second, the Net Promoter Score, quite popular. It's a likelihood that customers will recommend a brand to others. So we really want the apostles, the ones who are burning with the good news of our business. How do they, what's their percentage? So we come up with a score of 1 to 10 that qualifies promoters, usually the best 9 and 10, and detractors, which under 6. And we come up with the numbers of promoters, subtract the numbers of detractors, divide by the sample size, and get a Net Promoter Score. This is possible for customer, but it's also possible for employees. Think about it. Number 3, Customer Satisfaction Index. Here we come into the realm of very, very subjective testings, a sentiment analysis of a company's success at meeting customers' needs. So who is happy with our services? There are various ways of putting it, but they're mostly surveys that will come up with such an index. Fourth, another objective one, what's the retention rate? The portion of consumers remain customers for an entire reporting period. The formula would be customers lost in a given period divided by customers at the start of the period, and we have the customer retention rate. We know that retaining customers is much cheaper than gaining new ones. So this is an important number. Number 4, it's about customer complaints. Yes, also negative KPIs could contain valuable information. And if we have the sheer number of customer complaints or reworks per reporting period, this shows us the magnitude of problems that we have to address. Let's continue with KPIs for managing internal process performance. As with other areas, you can find hundreds of KPIs, metrics on the internet or in other books. Let's start with product defect percentage. This is another negative indicator. It'll give us the percentage of defective products in a specified time frame. So number of defective units in a given period divided by total number of units produced in a given period. That will give us the product defect percentage. It should be as low as possible, but measuring this problematic KPI is very, very important for alerting us if there is a problem. Second, order fulfillment cycle time. It's clearly the time it takes from customer order, there's a clear login time for that, to the receipt of the product or service by the customers. And yes, if we have to wait half a year from order to order fulfillment, this might become a problem. If a company cannot ship us within 2 days what we need, then maybe we will go somewhere else. Third, capacity utilization rate. This is a very important KPI for production companies, but actually it is important for almost any kind of business, because even if we just have, for example, a consulting business, if we cannot use our consultants and we cannot sell them to our customers, if we cannot use them, we have dead capital. So this is a metric which is used to compute the rate at which probable output levels are being met or used. So for example, if we are able to produce 1,000 switch boxes a year, and we are only producing 800, we are at the capacity utilization rate of 80%. Usually there's somewhere between 85 and 90%. There's a threshold for many production sites where we cannot be profitable. And capacity utilization is really important. The on-time rate, number 4. The percentage of time products were delivered promptly as scheduled. We all know what that means, right? But sending it in on time, sending in your homework on time, or delivering a product on time can be a real challenge. Not measuring it because it's convenient would be an issue. And finally here, number 5, the employee productivity rate. It's defined by the workforce efficiency, and it's measured over time. The formula is we take the total company revenue divided by the total number of employees, and we get the employee productivity rate. It'll end up with something like 200,000 euros per employee that we have. That would be a rather good number, because usually most of the employees don't cost 200,000 euros per employee. So it's the employee productivity rate is a good indicator of our business model and the industry we are in. Let's move on. KPIs for managing learning and growth performance. Some of you might find that familiar and a reminder of the balanced scorecard. It is. We'll talk about the balanced scorecard later on, but of course, yes, the balanced scorecard is one attempt to organize KPIs. So let's start here. Number 1, R&D expenses as percentage of sales. They show the relative R&D investments. Easy to calculate usually. The problem is we have here an indicator that it's an input indicator. We put something into R&D, but we don't know whether we've got positive results. Therefore, we come up with number 2, the innovation rate. It's gross revenue earned of new products or services divided by gross revenue earned in total. There are various subdivisions of that, but let's put it this way. What is the percentage of total sales that comes from products that have been released latest 12 months ago? So it tries to show us what are the new products and what is the importance of new products for our total sales. How young is our product portfolio? And of course, should be the result of effective R&D. Number 3, M&A investments as a percentage of sales. Why not? Investments are important, and in mature markets, maybe the investments into horizontal mergers might be the only way to keep on growing. You might also see what is your percentage of sales that is generated through businesses that you acquired over the last 3 years. Good. Let's talk about number 4, the sales CAGR. For those of you who've done the financial analysis video probably know that, but it's the compound annual growth rate. And it's the average growth rate over certain years. It is a very good indicator for a certain number of years, maybe 7, 10, 5, where you see how the growth has been over a certain or prolonged period of time. Yes, there might be a problem that the growth is not accelerating or even slowing down. Yes, the CAGR might be deceptive if you look at that area. Finally, number 5, the average training expenses per employee can be 5,000 euros, can be 2,000 euros. The idea behind is that learning is something that doesn't happen just per se, but has to be stimulated and paid for. So let's have a brief detour for digital startups. Digital startups usually have different numbers that are important, and we've seen some popular numbers and KPIs in that area. So the first one is about market potential, the first area, the total addressable market, TAM. Basically the world, or maybe if we have a product that's made for elderly people or service, then this market is reduced. SAM is a serviceable available market. Maybe the world is too big for us and we won't be able to address the total market. Some of the markets are capped by national legislation, so it's not so easy. And the SOM, it's a serviceable obtainable market. Maybe this is what we can realistically address over the next period of time, and can be maybe just the market that could be a regional market, could be a market that is limited to specific customers. So market potential is very important because it shows us the growth potential of a particular investment into such a startup. Second, it's customer acquisition and customer acquisition costs. So the question is, how much attention does the startup get? How many clicks does it get? We also have to look at bounce rates. A bounce rate means how people get on my website, and before going into any other sub-site on my site, they just get off the website. That's the bounce rate. The customer acquisition costs are important because there might be cost per clicks, we pay Google ads, things like that, and the question is, how much does it cost to get one customer? This is not just cost per click, this is our total marketing efforts that we have to pay for. Could be sales offices in Singapore and the whole world, and we take the total of this sales effort and we divide it by the number of new customers that we've attained. Beyond market potential and customer acquisition, we have to look at conversion rates, which is kind of a way of dealing with the efficiency and effectiveness of what we're doing. The conversion rates we talked about, conversion rates from leads to sales, from already started customer journeys to a real deal. The return on advertising spend is an indication whether a certain advertising campaign is working or not. In the digital world, where we depend on Google or other ways of attracting attention, maybe through online games or wherever, we have to really measure what is going on. Another point would be the Net Promoter Score. The Net Promoter Score is particularly important because if we have a new product or service, we need enthusiastic customers. And if the Net Promoter Score is very low, it is very complicated to maintain a story that the world is just waiting for a product, and we just cannot finance our growth. The problem is if your Net Promoter Score is not high, then probably you have to keep on working on your offerings. Yes, and finally, sales. Here we have the churn rate, so the number of customers who drop out, and especially for digital startups, we have MRRs, the monthly recurring revenues. Very important. So this is the money that comes in every month and that we can plan for. And last but not least, the CLV, the customer lifetime value. So how much does a customer bring us on average throughout this lifetime as a customer for this particular product, or even for the product family? KPIs for digital startups, or for startups per se, are complicated, and they really depend on the particular situation as well. But knowing these numbers won't hurt, and it will bring you closer to the thinking of venture capitalists. So now comes the main question: how do we develop new KPIs for individual situations if that's so complicated? So first of all, you have to understand the situation context, and for that you have to become an insider. Even if you're perfect in understanding situations, you have to first get into the situation, analyze it, and know what's important. Maybe this process is also an ongoing process, and you find out that actually the real things are not as obvious as you thought. Understand the situation context. So this is an ongoing loop. Second, you have to look for critical cause and effect chains. So what is driving what kind of other behavior? So if you, for example, if you have a certain amount of steps every day, then we assume from that this will lead to a better overall health situation. Yes, and then we identify measurable indicators. Yes, steps are not what is really measured in with our trackers. Fitness trackers cannot really measure steps. They measure movements of the hand. They measure movements that the tracker is exposed to. And coming up with the right algorithm to understand that this kind of movement would be a step and this kind of movement is just washing hands is very complicated. Yes, so a proxy in this case would be quite acceptable because it's the only thing that we have. Of course, if we have more things, for example, we have GPS tracking as well, we can see how many kilometers we ran during a jogging run. And then you can combine both numbers and your proxies get even better. How do you develop new KPIs for your individual situation? Think about your everyday things. What is relevant for you? Understand the situation, analyze cause and effect chains, and then come up with numbers that are measurable. And if you cannot find, if you know what's important, but you cannot measure it directly, then find indirect measures. Why do we do that? First of all, to diagnose performance. If what we cannot measure, we can't manage. This old management wisdom has been overused, but performance management starts with the diagnosis of performance. We can set targets, and smart targets we talked about. We can measure progress and analyze patterns and even make adjustments to our behavior. And this leads us to a very important point, because making adjustments to behavior is what it's all about. And KPIs are also a very important ingredient for game design and creating interaction design that is goal-oriented is something that we'll talk about later. So, Ladies and gentlemen, thank you very much for listening and eventually watching Value Drivers and Non-Monetary KPIs. I think it is the beating heart of performance management. Performance management without numbers is almost impossible. Numbers have a magical nature, and choosing the right KPIs for the right situations is very complicated, and if well done, can unlock value and energy. Thank you.